Hey guys, welcome back to another episode of AAFS Uncut. Today we are going to ask our good friend Leonard about some really tough questions because the house pricing now is an average 500,000 now in WA.
Probably more than that now.
Well, more than that now.
More, yeah.
Now, and there are a lot of people out there who are working as casuals and on contract basis. So we would like to know in this episode, can people who are employed on contract or casual, can they actually be approved for a home loan?
Absolutely, yeah. That's definitely, yeah, just a normal standard policy. Yeah. We can definitely help people who's on contract or people on casual.
And I think I want to know is like, what are the requirements? Because I know if you are full time, it's a lot easier. If you have a specific job, for example, like a medical doctor, then you have like this LMI waiver special loan thing.
Yeah.
But for casuals, for people working in service industries, like how does that translate?
So in general, if I can take a step back, in general, what the banks are looking for, they're looking for three things. So one is the income to service the loan. Number two is savings. So you need to have sufficient savings to purchase the property. And number three is you need to have good credit report. So if you tick all of the three boxes, then there's absolutely no issue for you to get the home loan. Now, going back to the employment of being a casual, so some of the things that the banks are looking for is number one, as a casual, they want to see a minimum of 12 months. That's in general. Reason why 12 months is because normally as a casual, your work hours can volatile a little bit. Where if you're doing part time or if you're doing a full time, the number of hours that you have is quite consistent. So that's why in general the banks are looking for 12 months work history. But saying that, there are lenders out there, for example CBA, where they're happy to look at 6 months of minimum employment. And they'll be happy to annualize the 6 months figure to use that income. And if you are, let's say, essential workers, for example, if you're working as a firefighters, police, nurses, then they're even more than happy to cut it back to 3 months before they can use the income as a casual. So that's Again, there's a lot of options out there for casuals.
What if someone were to move into a new job and they're casual, but they were casual in the job before and they've worked there for like maybe 2 years, and then they move into a new job and they're like, 1 week, and they're like, I'm trying to get a house.
Yeah, sure. So as long as you can show to the bank that you have normally between 12 to 18 months of working history, and if you have like a very minimum gap between jobs, so when I said minimum, it's normally less than 4 weeks, then they'll be more than happy to look into that as well. So you just got to look at the history.
So what you're trying to say is that like the lenders and the banks are looking for consistency, so they'll rather lend to somebody who has a history of not jumping around from job to job every 3 months or so.
Yeah, of course, correct. Yeah, that will be the preferred option. Yeah. Again, but they are in just different kind of industry. They have different ways of doing things. But in general, the banks prefer if you stay a longer period of time with a company, because that shows consistency.
Right.
Yeah.
So what are the factors that would affect like how much they can borrow and so forth, especially when it's talking about casual?
So with regards to the serviceability, it pretty much the same as how would you treat a full-time or part-time. So again, just whatever the income is. So they look at two things: so the income and whatever liabilities that you have, and also living expenses. So liability things like your credit card, personal loan, car loans, store cards, any home loans. Obviously, that will reduce your borrowing. And if you have children and whatever dependent, that obviously will reduce your borrowing as well. So they don't really treat between casual, part-time, or full-time differently in terms of serviceability. So they just look at the numbers of the income that you earn per year.
Right. So if someone was to work, because I know there are a lot of companies out there who would rather keep casual people working full-time hours because of the volatility and the uncertainty of the economy right now. So in that case, if someone were to buy a house, and I know that the cheaper houses nowadays are about $500,000 if you're looking at older suburbs around there, $500,000, $400,000 for like a 3x2 or so forth. So if they were to buy a house, considering 80% LVR and at the current interest rate at the moment, how much would they have to make in order to service the loan?
Yeah, so just the rule of thumb is you times whatever income that you earn per year. You can times it by 5 or times it by 6 at the moment because of the increase of the interest rate. I'll be a bit more conservative and I'll times it by 5. So for example, if you're looking for the $500,000 property, let's say you're borrowing 80%, so that's $400,000 loan. So if you divide it by 5, so you need to be earning roughly about $80,000 per year. I mean, that's just a very simple way of calculating it. Obviously, it'll get a little bit more complicated if you actually have like credit card, personal loans, you got kids, you're married. So that scenario was just like if you're single and you don't have much of any other liabilities. But if your scenario is a little bit more complex, do talk to us, and we'll be able to obviously help you out or to give you an idea of what is your maximum borrowing capacity.
So I guess the advice right now to a lot of people working casual, and if they are not and they don't have dependents, I guess, would be to start now, start saving up for the 20% deposit so that you don't have to get that LMI.
Yeah, so again, there's a number of ways of doing it as well, because number one, the government does provide a few scheme available to avoid the LMI. So the first home loan deposit scheme, so that will allow you to, if you're a citizen, that will allow you to purchase a property with a 5% deposit with no LMI.
Oh, that's fantastic.
Absolutely, yeah. And number two, they've got the Super Savers scheme as well, where you can allow they allow you to put in your your income to Super. That would be another easier way or faster way to save your money, because if you salary sacrifice your income to Super, then you have less tax payable. So and then you get more savings basically.
Or not, you can always ask your parents if they are nice enough to guarantee you 20%.
Exactly right, yes. The other way is to use your parental guarantee, absolutely. So if your parents has a property and have sufficient equity, we can definitely use that equity to help you to purchase the new property that you're buying.
So explain how would that work? How does that work?
So with the parental guarantee, in a nutshell, so you'll be purchasing the new property 100%. But what's going to happen is the bank will use the parent's house as an additional security to purchase the new property, bringing the total ratio equity to 80% lending. So that's how they allow you to do it. Because if no banks will allow you to borrow 100% because it's too risky.
Right. Okay. So I guess how we're going to end this is, what are some of the tips that you would let our viewers know if they're casually employed or under contract and they're trying to save up for a house during this slow economic season?
So the tips is the same, not just for casual. This is for everyone, especially if this is your first time looking to purchase a property. number one, do speak with a finance broker because they will be able to give you a good indication of how much you can borrow. So that will give so you have a rough idea of what you can or can't do. I think that will be definitely a good start. And number two, do your research. So like what I said before, there's a lot of government scheme out there that can help you out to save. And yeah, so just watch out on your spending. Obviously, those liabilities like credit card, personal loan, car loan, that will obviously reduce your borrowing capacity. So if you do want to buy a house now, I would suggest to don't have as many liabilities because that will impact your borrowing.
All right. So start saving up and start paying off all your student loans and debts, which I have not. And continue to ask your boss for a pay rise.
Absolutely.
All right. I guess we'll end the show here. Thank you guys for watching, and we hope to see you guys again in the next episode of AFS Uncut. I think the next one is going to be really interesting because none of us are going to be in the next one, right?
No, I'll be there.
Are you sure you're going to be there?
I'll be there. Yes.
Okay.
Okay.
All right. Cool.
I'll see you guys next week.